There is an incredibly appealing fantasy in the trading world. You link your account to a seasoned professional, step away from the charts, and let their expertise quietly grow your wealth while you sleep. But treating this system like an automated lottery ticket is the exact reason so many intermediate traders see their accounts slowly bleed out. The sequence of failure usually looks like this. You spot a trader boasting a massive 30-day return, allocate all your available capital to them, and watch your balance evaporate the moment market conditions inevitably shift. In the 2026 market, the old set-and-forget model has been replaced by a data-intensive ecosystem where AI-driven analytics flag strategy drifts in real time. Simply finding a profitable trader isn't enough when high-speed volatility and new regulatory transparency requirements demand institutional-level precision from every retail account. Navigating this shift requires more than intuition. It demands a strategy built on three specific pillars: vetting the infrastructure, auditing the underlying math, and implementing automated defense. Approaching copy trading as a demanding, active management discipline is the only way to build a portfolio that actually lasts. Pillar 1 is the platform itself. Even the most brilliant trading strategy will fail if the infrastructure underneath it is compromised. This starts with top-tier regulatory compliance. You need absolute certainty that your capital is held in segregated accounts, entirely separate from the broker's operating funds. Then comes the cost structure. A platform might advertise zero commissions, only to quietly erode your profits through massive spreads or heavy withdrawal penalties over time. And today, basic social features are no longer enough. The baseline standard requires deep AI integration to help you parse through thousands of data points and verify trader performance. Verifying the integrity and technological strength of your trading environment is the mandatory first step before you risk a single dollar on a master trader. Pillar 2 is asset selection. In this environment, the cardinal rule is to never evaluate a master trader by their headline profit percentage alone. This side-by-side chart compares two hypothetical portfolios, Trader A on the left and Trader B on the right. Looking at this graph, Trader A has generated a massive 500% return. But that return is built on a terrifying 60% maximum drawdown, meaning they frequently lose more than half their account value before recovering. On the other side, Trader B's chart shows a seemingly modest 150% return. However, this is paired with a highly controlled, tightly managed 15% maximum drawdown. To cut through the illusion of raw profit on these charts, we use the Sharpe ratio, a metric that calculates exactly how much return a trader generates for the specific amount of risk they take. Trader B's high Sharpe ratio proves they are the vastly superior choice. True master traders are identified by their mathematical consistency in protecting capital during inevitable losing streaks, rather than their ability to hit lucky spikes of profit. Pillar 3 focuses entirely on defense. The ultimate responsibility for capital protection belongs to you, not the master trader. You start by spreading your capital across 3 to 5 completely non-correlated traders. You pair a high-frequency scalper with a long-term swing trader, so their strategies move independently of each other. Next, you implement strict automated controls. You set a global equity stop-loss based on the 1% overall account risk rule, automatically cutting ties with any trader whose drawdown suddenly exceeds your limits. You also deploy modern AI as an active co-pilot. These tools constantly monitor your portfolio, instantly flagging you the moment a master trader deviates from their historical risk profile. Building this automated, diversified defense architecture ensures that a single trader having a bad week doesn't drag your entire portfolio down with them. Even with pristine platform infrastructure and flawless data analytics, the single greatest threat to your portfolio is your own psychology. The most destructive trap is the fear of missing out. If you jump onto a trader's coattails immediately after they post a massive winning streak, you are mathematically guaranteeing that you are buying at the top, right before a natural market correction. Global markets are in a constant state of flux, and the traders navigating them must adapt to survive. That means continuous, active monitoring of your chosen master traders is a non-negotiable requirement. Successful copy trading requires engineering a resilient, adaptable machine capable of weathering any market condition. To build your future-proof 2026 portfolio today, explore FXNX's advanced analytics, AI-driven filtering tools, and institutional-grade zero point zero pip spreads.